Okay, I've got 12:03 Eastern time on my end, so I'm going to get started with respect to everyone's time who's jumping in today. Good morning and good afternoon again for those of you who are West Coast, East Coast, different kind of things. Really appreciate everybody giving this a listen during I'm sure a busy week, busy day, all that kind of good stuff. This webinar that I am going to be going through, hopefully in about 30 minutes. Would like to keep it to that 30-minute piece. We'll have some existing clients of our firm, Amplius Wealth, as well as some non-clients or folks who have just been poking around some of the information we've been sending out recently. So for the clients that are on the call, I know you've heard me talk about some of these things already. And for those who are not clients, welcome. Appreciate you jumping in. So, all right, let's get started. So first of all, for those who are not clients of our firm, of myself, who am I? You may have seen my name pop up on social media ads or from phone calls or different stuff on LinkedIn or an email and all that kind of stuff, which is what would have brought you here today. I am Patrick Swift, same guy in the picture, just with the beard now. And I apologize in advance for dressing like a sort of classic financial advisor. We're actually doing pictures in our office today, so I figured I should look the part. Let's jump into things. So to kind of set the table, our firm, just to background a little bit, is an independent fiduciary wealth management firm. I'm a financial planner and a partner at the firm. A lot of the clients we work with at our firm, Amplius Wealth Advisors, happen to work in the enterprise software space at VMware. And just to set the table again, just to show you kind of what this webinar is going to be about and what we hope to hit on and what it won't be, I'll actually start on the right-hand side of the slides you're looking through here. This is not insider information. All of you, most of which I think, if not all, are VMware employees, probably know more about the goings on and the day-to-day stuff with regard to the acquisition with Broadcom more than I do. So this is not insider information, nor will this be my predictions about what's going to happen, what you should be doing with your life, what you should be doing with your money. I don't have a magic formula for anyone. What instead my hope for this to be is a discussion around, hey, if I was sitting in your shoes today as an employee, what would I be thinking about? What should I be thinking about from a financial planning standpoint as a result of the acquisition and where we are in today's world? Hope to give some third-party perspective. Our firm has a lot of experience with employees and executives going through acquisitions, both for public companies, private companies. So we've seen a few things and how it affects people both personally and financially. And hopefully we'll explore some scenarios and how they could actually affect you as a result of the acquisition itself. Quick disclaimer, I know it says it there, nothing on this webinar should be construed as tax, legal, or investment advice. Everyone's situation is very individualized and one-on-one. Any of those topics and questions should be discussed one-on-one with the appropriate advisor. And on that point, I'll mention on my next slide here, we'll try and get to some Q&A today. If you have questions, please keep them general. Do not ask, what should I be doing with this, or what should I be doing, or what should I be thinking about? Let's, because I won't be able to answer anything that's personal, obviously. So moving forward, again, just to touch on, as people are still jumping in here a little bit, why should you listen to me? So for the clients that are on the call, hopefully that question's already been answered. For those who are not clients, why should you listen to me? Again, I'm a partner and a financial planner at an independent fiduciary wealth management firm, Amplius Wealth Advisors. We're outside of the Philadelphia region in the suburbs. And a lot of the clients that I work with in particular are employees of VMware. So what that's allowed me to do over the years is gain a pretty comprehensive understanding of their benefits and financial planning concepts that are specific to them. In addition to that, I'm also able to be a bit of a third-party, unbiased advisor to them around the stock price and things that are going on at the company that they can use as sounding board. It's good to sort of get out of an echo chamber, obviously, when you're hiring an advisor, and we try to provide that for clients. In addition to VMware, a lot of the clients I work with happen to be in the broader enterprise software and IT sectors. So we have clients who are not just at VMware. So we're pretty familiar with the space. That allows us to give some niche expertise around folks who are in the IT and software sectors, what kind of financial planning really resonates and is specific to them. Most importantly, I am not affiliated with VMware in any way. So don't assume I am. And nor am I affiliated with Broadcom in any way, shape, or form. So just kind of throwing that out there as well. So in terms of get into the meat and potatoes of our presentation here today, a couple things we'll touch on. Next, I'll just touch on where things are, just from a public information standpoint, and so I'll provide some thoughts on that. And then we'll hit on some specific planning strategies that we've been sharing with clients and conducting with clients that I think are, going back to what we said on the last slide, important for folks to be thinking about in your shoes today. So a few of those you can see here. We'll talk about a mega backdoor Roth 401k. If you're familiar with that concept, great. If not, we'll go over it, and I'll touch on some things that you might not be familiar with if you are doing it now. We'll touch on non-qualified deferred compensation for senior directors and above, the current stock price, what a strategy should be if you own a lot of the stock currently, the fact that the employee stock purchase plan is frozen. We'll talk about other benefits, and like I said before, there is a Q&A function on your webinar as a participant. Please try and send some questions my way if you're going to send any towards the end, and again, just keep them as general as possible. You can ask whatever you want, just don't ask like, hey, my taxes were this year, what do you think about that? Like, I can't answer that, obviously. All right, so where do things stand today? So as many of you know on the call, it's under regulatory review across a bunch of different regions. Namely, the most public one that you keep seeing pop up in the papers publicly again is the European Union and the Commission there. They just recently extended their deadline for review of their investigation to June 21st, 2 weeks past what they originally were considering. And on that point, we are expecting very soon, in fact, this month, for the EU to provide Broadcom with their objections to the deal, which Broadcom will then have the ability to respond back to in a hearing format thereafter. So the EU has kind of been the most public face of regulatory scrutiny so far. Nothing abnormal yet, but just for what it's worth. Obviously, the US Federal Trade Commission and in the UK, their Competition and Markets Authority are also reviewing the deal. Here's one that I think is worth mentioning. In China, their State Administration for Market Regulation, they also review these deals. They've got a hand in the regulatory process as well. The reason why I bring them up is not to be political in any sense, shape, or form, but the China and US relations since May of last year when the deal was announced haven't exactly sweetened. I don't think that's any surprise to anyone. Particularly, it has not sweetened with regard to semiconductors, which obviously the lion's share of Broadcom's business comes from. So again, going back to the first slide, not making any predictions here. For what it's worth, they will have a regulatory say in some of these decisions as well, and it'll be interesting to see if they have any pushback or spiteful types of looks at things. Now, despite all the regulatory review, management of both companies have been publicly verbal, and I'm sure internally verbal, that they expect the deal to close with minimal pushback at the end of Broadcom's fiscal year, which is October of 2023, which is all fine and dandy. If you look at the stock price, right? So I mentioned before, we keep pretty close tabs on VMware stock price. Really, since December 1st, the stock price has traded in a pretty narrow range, except for maybe 1 week right at the end of February where it dipped closer to 110. The stock price has jumped around $120 a share, and it's mostly stuck right in that range for the last few months here. I read that as a couple of things, and Westchester Capital Management, actually, which is a firm that exclusively focuses their investment philosophy, their focus on mergers and acquisitions. The dollar amount of the share price of VMware is related to what investors think about the acquisition, right? The deal got announced at $142.50 per share. Today it's at $120. Why is it not at $149? Well, the $120 is a function of investors in the market trying to figure out if it's going to go through or not. I would say, gun to my head without any sort of math, 120, it seems like hey, investors feel pretty good about it, but they're not sold yet. They're not sold that it's for sure going to happen. And that's backed up by this gentleman who you could find in the news, Roy Barron. He's the chief investment officer at this company, Westchester Capital Management. We have absolutely no affiliation with them. They bet on these things. They bet on if the acquisition or merger is going to go through for any public company. Back in January, their internal financial model had the deal going through at 60%. Fast forward to early this month, it's as low as 36%. Now, what's misleading about that and worth mentioning is 36% doesn't mean the likelihood it's going to go through. In fact, I personally think it would be much higher than that. It's a function that they use of the current stock price and the acquisition price. So before anyone gets alarmed, their model is a little bit different. All that is to say, the whole point of this slide and my whole spiel on it is this isn't necessarily a slam dunk. There's regulatory review, and the stock price isn't exactly flashing red lights that the acquisition is going to go through. So for what it's worth, I think that's a good place to just kind of set the table on where things stand. Now, what does that mean for employees, executives, people who are working for VMware today? Aside from those who are very much in the know of regulatory approval at the very tippy top, things that I would be taking advantage of, I guess, even if you are an executive in those shoes. We'll talk about these in particular, in specifics, and I'll detail them as well. But I would be taking full advantage of your benefits today. At Amplius, we're firm believers in controlling the things that you can control. So not making predictions or speculating, but what are the things that you can focus on today? One of those things is taking advantage of the benefits that VMware gives you today. So the mega backdoor Roth 401k, I will touch on that on a separate slide coming up here. Legal benefits. So I don't know enough about Broadcom to tell you exactly what their benefits will be when the company transitions there. I will say this though, we're big on estate planning at the firm. And I'll share a stat that I just saw this week. 80% of Americans, so 8 out of 10 of you on this call, would like to transfer money to your heirs at some point, or a charity or someone. Only 50% of you, are a little less than that, so half of you actually have an estate plan. That's important, right? So maybe as you're waiting for things to shake out and you've enrolled in legal benefits, that allows you to conduct with an attorney and get some estate planning done. I can tell that's a whole separate webinar topic that I'd be happy to talk to anybody about. But for what it's worth mentioning, these are benefits that you got today that, I don't know what will happen with them post-acquisition necessarily. Healthcare elections, pretty minor stuff. But look, if you got a full health savings account or you've got a full flexible savings account, maybe consider, if you had a procedure that you wanted to get done, maybe now's the time to do it, right? Use the benefits before they go away at the end of the year or before an acquisition and do what you can with the money. Charitable match contributions. We'll talk about a few more of these things specifically. The other really big ones, that's what we'll focus on today. Non-qualified deferred comp. Again, senior directors and above have access to the non-qualified deferred comp plan. I won't go into all the details of it, but if the acquisition goes through, will it pay out upon the acquisition close, which would be different from what those elections are? How does that change your tax situation? How does that change your cash flow, your financial plan, all those types of things? I'll hammer home a little bit about stock exposure and strategy for that. So if you're exposed to a ton of VMware stock, what the heck should you be thinking about? Not advice, but just what should you be thinking about? I will touch on that and what our approach for clients is with regard to stock concentration. And then lastly, another kind of just minor thing, ESPP. If you're participating in the employee stock purchase plan, you're buying stock every 6 months, that's frozen right now. And if you're maxing it out, I want to say $15,000 of savings. If that's frozen right now, what are you doing with $15,000? If that was part of your financial plan, you should probably save that somewhere else. Inertia is a big thing. So if you're not doing it because the plan was frozen, you got to get back on track with those savings somewhere else. So we'll touch on all these things. So things to consider. Let's get into some specifics here. Mega backdoor Roth 401k. Again, I can't hear any of you guys, so I apologize if anybody's eyes are rolling or they're saying, "Oh my God, I already know about this," or thanks for showing up. I would say if you are that person, you're saying, "Look, I already do this. I'm jumping off this webinar." Hang on for a second. There's some thoughts here that why you may want to listen and things you might not be understanding about it completely. And for those of you who are like, what is this guy talking about? What is a mega backdoor Roth? I'll explain it high level. What the mega backdoor Roth allows you to do, in a nutshell, it allows you to put more money into your 401k at VMware on top of what the IRS deems to be your maximum this year, which is, as you can see on the slide, $22,500. If you're over age 50, we'll talk about it in a second. Current IRS maximum that you can take out of your paycheck is $22,500. The after-tax portion, so if you go into the net benefits page on Fidelity, where you log into your 401k and you change your contributions, there's a bunch of different places you can change your contributions from your paycheck, but there's 3 different tax treatments of the choices you have. You'll see pre-tax, you'll see Roth, and you'll see after-tax. You might be thinking like Roth after-tax, isn't it the same thing? They're not. That limit that I just mentioned, the $22,500, that applies to pre-tax and Roth contributions. So if you do one of the two or both, you cannot put more than $22,500 in 2023 into your 401k. Now, if you hit that maximum already, or you're going to at some point, you could, or simultaneously, elect these after-tax contributions. What that allows you to do is you'll start taking more money out of your paycheck on top of that 22,500 limit and put it into the 401k. So it's excess savings. That's excellent, right? So just so you know some of the numbers shake out, going back to that limit, you got $22,500. VMware is going to give you another $9,000 or so to the 401k. So your tapped out max limit for this year would have been what is that, nine? Some of you guys are probably better at math than I am. That gives you $31,500. Well, guess what? The total limit that the IRS will allow you to put in this year through this mega backdoor Roth strategy is actually $66,000. So do the math. What's the delta? $34,500. That's how much you could put in on the after-tax portion of your 401k. So that's all fine and dandy. Let's say you elect it. That's great. Okay. Here's where the IRS sort of gets the caveat rule as to why you can do this. The money that you put in after tax, it's going to come out of your paycheck. Guess what? After tax, crazy concept around how they named the after tax contributions. So you're going to pay your federal income taxes and your state income taxes, and then they're going to take out a after tax contribution. As that money goes into your 401k, it's going to get invested the way it would anywhere else. Target date fund, whatever funds you're using within the account are going to be what the money gets invested in. Now, any earnings on just the after tax portion of your contributions will be taxable in the future. So let me say that again. Let's say you put in $10,000 to your after-tax bucket in the 401k, and in 20 years that doubles to $20,000. When you take out that $20,000 from your 401k, 10 grand will get returned to you because you already paid your taxes on it. No taxes due. The other 10,000, all taxable, right? So some of you who might be on this call rolling your eyes saying, I already do this, and you leave your after-tax 401k contributions in the 401k, not my favorite strategy. Here's why. What we do for our clients at Amplius is we elect these contributions usually in the third and fourth quarters because we want to try and eliminate the amount of earnings that those after-tax contributions are going to get so that we don't have to pay taxes on them in the future. And then in the new year, January, usually every year, we go ahead, we call Fidelity, we pull those dollars into a Roth IRA. Now, the benefit of a Roth IRA is you'll be able to reinvest that money and all the earnings will be tax deferred. And if you hold on to it for the right amount of time, when you pull withdrawals out, both your contributions and the earnings are tax-free. So it's a no-brainer strategy. Now, some of you might be lost. That's fine. Let's talk about it separately. The reason why so there's a whole separate, I'll just mention this, we'll move on. There's a whole separate feature in your 401k called in-plan Roth conversions. Now, without confusing everyone too much, all that allows you to do is on an automatic basis, you can take money in your 401k that you contribute on a pre-tax basis, and you can convert it into the Roth portion of your 401k. So you pay the taxes on it now, so you don't have to do it in the future. Now, if you're doing after-tax contributions and you're not moving that money into a Roth IRA, you're just leaving it in your 401k, that money is going to continue to accumulate taxable earnings that you'll have to pay tax on in the future. So even if you're doing in-plan Roth conversions, all that's happening is you're just taking those taxable earnings each year and you're just paying taxes on them. In my opinion, and you don't have to agree with it, I think you're better suited to take the money from the after-tax portion of the 401k and move it into a Roth IRA. I know I'm getting some questions on this topic, which is a good thing. Hopefully it's something that everyone's curious about. I'm going to try and come back to them if you guys don't mind. But moving on, last point on the whole idea here, the whole planning, the whole plan and strategy itself. During an acquisition, bringing it back to Broadcom VMware, it's not uncommon for your 401k to get frozen for some period of time. I believe Broadcom also uses Fidelity, but it's possible. I've seen this in the past. For some period of time, a month, couple months, less than that, you may have your 401k transferring from the VMware plan to the Broadcom plan. We'll actually talk about that a little more later. During that period, it's possible, again, I don't know for sure, I have no idea. It's possible you'll lose some control, right? You may not have the ability to change your contributions, who knows? So if you're going to do after tax and this mega backdoor Roth strategy, with our clients, we do it third and fourth quarter. Maybe it makes sense to do those earlier in the year. Do them now before you get more acquisition news. I'll wrap it up on the 401k side of things there, and I will touch on some of these questions hopefully in a couple of minutes. I really appreciate everyone being kind of involved and sending some questions over. So moving on, What other things should you guys be thinking about? Non-qualified deferred compensation. I'll try to keep this one brief. One, because there's not that much that you can do. And two, it may not apply to every single person on this call. Non-qualified deferred compensation. Again, senior directors and above at VMware have the ability to elect non-qualified deferred compensation. Now, the first bullet point here, this is directly out of the non-qualified deferred comp plan guide for this current year. So at the end of December, when you had to make your elections, this is what was in the piece there. I'll just read it real quick. So VMware plans to operate its non-qualified deferred comp plan in the normal course through close. Broadcom has not yet provided any information regarding its plans for the non-qualified deferred comp plan. Such information may not be available until after the acquisition is complete. You're encouraged to consider this uncertainty as you make your elections, is what it goes on to finish with. What that means to me is, and without getting into the nuances and specifics and details around what a non-qualified deferred comp plan is it represents essentially a liability that Broadcom may have to pay to the current employees. So because VMware hasn't gotten word, they haven't figured this part out yet, it's possible that you've got three different scenarios that are going to play out. The first one, which would be the most intense, but not impossible, is an accelerated vesting of the benefits upon a change in control. So change in control means the company got sold, got acquired. So you could have an accelerating vesting of the benefits. That would mean any benefits you have in the non-qualified deferred comp plan could, again, keyword being could, pay out to you. And when that happens, it's all taxable as income. So if you huge amount of deferred comp saved up, that's a big amount of income that you're going to have to pay taxes on. There's, again, I'll touch on strategies, why that may not be a great thing, but there's not that much you can do about it for what it's worth. The other two that could potentially come out of this as well is Broadcom continues it as is. They just say, look, no problem. We're going to honor everyone's benefits. We're going to honor everybody's elections and distribution schedules. Maybe we'll change some stuff in a go forward basis, but existing benefits, they're exactly as is. And again, maybe you guys have already heard some of this, and maybe you already know how they're planning to do things. I do not, but I'm trying to help people plan for it. Some combination of the two, meaning, hey, they come to an agreement. Look, if we accelerate all these benefits, it's going to be a huge tax situation for all these folks at the company. We don't want that. Broadcom works and says, okay, no problem. We're going to accelerate the benefits to some extent. We're not going to have it all pay out at once. So there's really only three ways it's going to play out. And those are the three, at least in my opinion, in terms of what to look for. I guess it's possible they could just scrap the plans. I just don't think that would sit very well with people who are going to stay on board after the acquisition closes, for what it's worth. So what do you do about it? My thoughts would be, what are your solutions? Have an advisor who does tax strategy. A lot of financial advisors don't. If you're working with Fidelity Net Benefits, executive benefits team, they do not provide tax strategy. Our firm, as an independent one, does. In the, again, third and fourth quarters, we review clients' tax returns. We go through projections with them. We look at what's going to change this year, how they could potentially change their tax bill. So if we get some clarity on this and it's like, oh my God, I have this big tax bill coming, let's sit down and look at it. So let's figure out what we can do. And there are certainly some strategies that we can point to try and help reduce that burden. I'll just share one other thought, why it may not be the worst possible thing in the world if all of your benefits get vested and you have this huge income payout. Number one, again, without getting political, is as of today, and this comes from a few third parties at big think tanks that we get research from, we're in a pretty low federal tax rate environment for what it's worth. And it's possible that the law that changed in 2017 could roll back. In fact, it's supposed to roll back at the end of 2025, meaning tax rates could go higher. So if you're going to get all this income paid to you, yeah, it may not be the most comfortable tax bill currently. You can plan for that, but you may actually be getting taxed at it at a lower rate than you might be in 2025 or later, for what that's worth. The other idea is, hey, you're going to get a whole bunch of income that you weren't prepared for. Not the worst problem in the world to have. Maybe it's time to do some Roth conversions. Maybe it's time to do some stuff with that cash now that you have control and access to it. So more thoughts. Again, those are very individualized conversations, one-on-one conversations. But we'll just for what it's worth, those are some thoughts. Stock price. And again, just so everyone knows, coming up on 12:30 Eastern time. I don't want to keep everyone's day, for forever. We started a few minutes later, but I'm just going to keep going here and then hopefully get to some questions because we got a few coming in. Stock price. All right. So big chart here. I'll touch on that in a second. I mentioned in that original slide about investor sentiment, it's been pretty range bound at 120 for the last few months, kind of reflecting what we were just talking about before. Now, I've been getting a lot of questions from clients and prospective clients saying, well, look, if the deal's going through at 142.50, why wouldn't I just hold my stock? That's an implied 18% return between now and then. My answer to that is, well, one, like we talked about before, this isn't a layup. So if it doesn't go through, keep it simple, stupid. What should VMware be worth? I don't know. I don't have the answer to that. Wall Street traders don't know, or they'll try to figure it out. I don't think anybody knows, right? So you can come up with book values and all that kind of stuff. But point being, who knows? If the acquisition goes through, or you got some unforeseen events that occur. I wouldn't necessarily bet the sort of bet the hen, if you will, on it going through at 142.50 necessarily. Now, aside from that, let's say it even does go through. The chart below, which I use, this is the 12-month rolling returns for VMware stock, which is the purple line, versus some major stock market indexes. As you'll see, this is through yesterday's close. Today, I think it's even a little higher. VMware stock is up about 3%. That's nothing to write home about, for what it's worth. But if you look at it relative to the S&P 500 index, which is basically the US stock market, which is the orange line, and then you look at it versus all the other international stocks, which is the MSCI All Country World Index in blue, both of those stock market indexes are down more than 10%. So that old Warren Buffett adage, I am not, but he says, look, you want to sell high and you want to buy low, right? So just looking at it in isolation, if you've done well with VMware stock, you have too much on hand, you need to diversify. It's not the worst time to diversify. I don't care about the 142.50 really, because if you're going to be diversifying into other stocks, guess what? You're getting in at a lower price. You've got better valuation. And those are all individual conversations that you need to have with someone. But I don't think it's a slam dunk. And for what it's worth, the stock price relative to other places you could have had money have not done poorly. If you consider that fact and you were investing in other things, who knows what your returns are in the future versus the implied acquisition price. So for what that's worth, their biggest takeaway, my biggest takeaway, what I tell everyone, and I scream it from the rooftop if I can, is do you have a plan? Like, what is your plan for your stock strategy? How much do you have? Like, how do you think about it? So let's touch on that. At our firm, we have a pretty rudimentary, three-pronged approach to equity reward management, or hey, I have too much stock. This applies for whether you're being compensated in stock or you just have too much stock in your portfolio in general. It's three rules, very simple. Current percentage of your liquid net worth. So if you look at your total liquid net worth, what percentage of your stock makes up that net worth, right? So you've got 20% of your net worth in one stock, that might be a lot. So what is that number? Do you know that number? Does anyone know that number? You got to figure out what that number is first. That's step one. You got to know where you are. Now, when you're working for a company where you get compensation in stock awards, there's only so much you can do to some extent. However, you still got to know, like, hey, what's my strategy here? Once you've figured that out, what should your target be, right? So using an advisor to kind of figure out from an unbiased, objective standpoint, what should your target be? And really, the answer to that question is it depends. But I'll say this, if you have any amount of stock in your portfolio, I don't care if it's your company or any stock or any investment for that matter, that if that price went to zero, it would ruin your financial goals. That's too much, right? So sort of simple stuff here about being diversified, but it's inertia, right? You don't pay attention to it. It grows, it does well, which is a great problem to have. You got too much in your portfolio. So what should your target be? It depends. As a rule of thumb, just to shoot out some numbers, if you're working for a company, you're getting a ton of stock. If you have 15 to 20% of your net worth there, unless you're like a super executive and you got issues with the liquidity, that's probably time to look at it and say, again, relative to my financial plans, my financial goals, what is too much? Once you figure that out, what's the most tax efficient way to be there? So for VMware, a lot of folks have restricted stock units, or they participate in the employee stock purchase plan, or both. They both, restricted stock units, employee stock, they have two totally sets of tax rules. And if you don't understand those tax rules, you should, because they're important when you're figuring out what to sell, what not to sell, what to hold, all that kind of stuff. We do all of that internally for our clients. We make sure that we're actually coordinating on those things. So that's kind of step number 3. All right. So where am I at today? What should my comfortable target be? And what's the most tax efficient way to get there? Pretty simple, but that's what we follow and that's what we instill and talk to clients about. All right, moving forward here, coming up a couple of minutes after 12:30. I apologize if people had to run to other calls. Closing thoughts. So a couple other things just to keep in mind outside of the mega backdoor Roth, the stock price, non-qualified deferred compensation. Again, I mentioned before, your employee stock purchase plan is frozen. It's pretty simple, right? But if you did a financial plan, which our clients do with us, and it had us saving $15,000 a year to your employee stock purchase plan, well, those savings aren't occurring anymore, right? So it may seem minor, but you should replace them. You should put them somewhere else. You should invest them elsewhere. You should make sure that those savings are still part of your plan, even if the plan is frozen. On the 401k, I know we talked about the mega board backdoor Roth specifically, but often with acquisitions, I mentioned before, there may be a transition period where your 401k transitions to the Broadcom plan. What I've also seen happen is the company allows you to take custody. They may say, hey, look, you can move it to the Broadcom plan, or you can do whatever you want with it. Meaning you could move it to an individual retirement account. You could convert the money to a Roth IRA. You could take a distribution, which might not be the best thing to do. But you would actually be able to take custody of those assets. So being aware that that's on the horizon, a decision that you may need to make, is another thing that you want to talk to somebody about. Hey, should I do this? Does it make sense? I have assets over here. Does it make sense? There are pros and cons of all of it. There is no one size fits all answer to that. So just something to be in mind, be aware of. Other things are just questions that, again, I would be asking if I were in your shoes. Am I going to be happy at this combined entity? We've been talking to clients a lot about that. Culture changes, job changes. That's an important piece, right? If you're going to be planning for something and you may not know, and you're going to be looking for different work potentially, that's got to be part of your financial plan. You need to have some scenario comparisons there. And again, what would be the worst case scenario? How would different scenarios affect your retirement or other goals? These are all things we're talking about, but just questions that I'd be thinking about. And lastly, I mean, do you have a team of professionals coordinating things for you? The answer is no. Look, that's what we're here for. That's why I'm doing this webinar for those who aren't already clients. Give us a call. We're happy to talk to everyone about their specific situation, what we would be thinking about. Just a minute or quick plug on us again. We're an independent wealth management firm. We're a fiduciary fee-only firm. We don't get paid by the hour. We don't get paid to sell you products. We're here as a consultative piece. So right now, people are probably getting ready that they need to jump. I'm gonna look at a few of these questions, see which ones we can try and get to. And you guys can take a look at the quote that I threw up there, which is one that I love, which is, hey, a good plan that's actually executed proactively, voraciously, much better than a perfect plan that you never do anything about. So that's kind of the whole crux of this webinar today. All right, so I've got a few questions here, and I just want to read through them before announcing them in case any of them are very individualized. Right, okay, so great question. Most of us are not eligible for a Roth because we make too much. Wrong and right, I should say. Yes, if your income is above a certain amount, you cannot contribute to a Roth IRA. Roth IRA, you could do a backdoor Roth IRA. I'm not talking about Roth IRAs at all. I'm not talking about IRAs at all. I'm talking about your 401k. You could make $1 million, $2 million, $6 million, $1 million, $100 million of income in a given year. If you have a 401k, which VMware does, that allows you to make Roth contributions, you can make Roth contributions. Same thing on the after-tax mega backdoor Roth strategy I was talking about. I don't care, and that's actually why we do it, right? Because most of our clients have too much income. They can't contribute directly to a Roth. Even if they could, the limits are only $6,500 this year, $7,500 if you're over age 50. The after-tax portion allows you to put, what did I say before, $34,500 that you could backdoor into a Roth IRA. So that's how you do it. That's exactly what the strategy is for, hey, I make too much money. So hopefully that answers that. So I'll click, I don't know if I gotta click that one off. I'm just looking through a couple of them. What's recommendation? So more general question, or a little too individualized for me to answer here. Question was, what's your recommendation on 401k withdrawals for over 59.5-year-olds? Give me a shout. We should talk about that. It really depends, right? If your situation, I'll share this kind of generally. When we're looking at someone's retirement plan, what they're going to need money for, and when, we come up with a tax efficient withdrawal strategy. Oftentimes, but not always, it makes sense to try and allow your retirement assets to grow for as long as they can. Your 401k, your IRA, Roth IRAs, all that stuff has tax deferred benefits. So your investments are growing without you having to pay taxes on them. So because of that, we may want to let those be aggressive and grow as long as you can. You may not want to retire at age 60 and just start pulling out of those. So you have other assets to pull from. Usually that ends up being, not always, but can be a better strategy, but it's a very individualized question. It's hard for me to say because I don't know anything about your situation, but so hopefully that helps a little bit. Yes, I know I probably mentioned it like 8 times, but you might have asked it before I even mentioned it. The non-qualified deferred comp is only available to senior directors and above. So again, I apologize if I spent too much time on that, and there were a couple of folks who it didn't apply to. I know there were a bunch of people who it did apply to as well on this call, so I wanted to touch on it. Let's see what else. Got it. Stock price. Yes, so just a sort of a not necessarily a question, but more of a comment about holding stock, long-term capital gains. Yes, you are right. It's more nuanced than that. Employee stock purchase plan is not long-term, short-term capital gains. Employee stock purchase plan has a qualified and non-qualified disposition rules. There's always an ordinary income component to that if the stock price is up. It's not as straightforward as that. And again, going back to our stock, I know I talked about our stock award strategy being very specific 3 rules, but it's more nuanced than that. If you have restricted stock, any ESPP, I actually favor selling your restricted stock as it comes in, so that you, for a couple of different reasons, but you're not wrong. Yes, long-term capital gains, you hold an investment for 12 months in a day, you get preferential tax rates. Absolutely, definitely more preferential. But there's nuance to that. And I have some really specific thoughts around that I'd encourage you to seek me out and we can talk about separately. Last couple ones here. And so I just want to see again if this is specific to anyone individually. Oh, yes, absolutely. So when I said before, the potential that the VMware 401k could be frozen, again, it may not get frozen at all. But oftentimes in an acquisition, if you're changing a plan provider, your current 401k has to transition to the new provider, so it could get frozen. The question was, hey, does that mean we can't add to it? Will it continue to grow? Yeah, it'll continue to grow. So your money is still in the target date fund. Your 401k is in an ERISA a governed trust. So nothing can happen to the funds. They're your funds. They're going to continue to grow in the investments that they are. You will likely, if that happens, have to pick a new investment. You'll get defaulted usually into a target date fund at the new firm. That might not be the best thing for you. If you're invested, 100% in stocks because that's your strategy in your current 401k, and the Broadcom is going to move you to a target date fund that's 50% stocks, that's probably not your best interest. You should be aware of that. But yeah, and when I say frozen, that's an ambiguous term. Like, you may still be able to make elections, but you may have a week where it's going to not be available on Fidelity or whatever. But I've seen different things shake out. All right. Couple more here. I appreciate everyone staying on. For those of you who are still listening, just looking through to see if anything else is terribly individual. We are taking on clients right now. Not a ton. We do have specifics around the types of clients we're onboarding at any given time, but we are taking clients on. We do have very specific expertise on stock awards, not just the restricted stock units. So that's a great question. So I mentioned before, we have clients in a variety of industries, and they get incentive stock options, non-qualified stock options, all kinds of different equity compensation. We do have a ton of expertise there. Got it. I don't have a prediction around what's going to happen. I would say, again, what I tell clients every day: control what you can, minimize regret, right? So if you can control what you can, and you can look at upside downside factors, that's what we're here for, to be the third party unbiased opinion, and minimize regret around decisions you're making today. That's going to help you. So I think with that, I'm going to end it. I know we went a little bit over time. I really appreciate everybody's attendance. We're going to be sending this out in an email follow-up for all of those who registered. So you'll get this recording for you to use in the future. I'm not going to send out the PowerPoint, but you'll get the recording. And in that recording, I'll have my contact emails, which have been up on the screen for a minute. I'm also going to put my calendar link in there for 15-minute or 20-minute segments for follow-up questions. If people want to have one-on-one conversations, we're not going to invoice you. I'm not going to charge anyone for a 15 to 20-minute conversation. So I'd encourage you, if you have more questions, jump on my calendar. We'll talk about it. And in the meantime, we'll be sharing more updates as developments occur. Again, I appreciate everybody jumping on, and I hope this was helpful, and I hope to hear from you. Thanks.